Hey, have you ever received such messages in your phone? If yes, believe me, you might have been their next target. Generally, it has been seen after opening a demat account with any broker. We start getting random calls and messages through unknown advisories, companies, and scammers. Usually, they try to convince and try to bring into their trap. But the question rises here, what kind of trap? Well, the trap of exercising fraud activities and cheating you for the purpose of making money. But fear not, this video will help you to safeguard from such fraudulent activities. But before that, let me introduce ourselves. We are PA Wealth, an investment services group. We offer stocks, PMS, mutual funds, alternative investment funds, insurance, and startup investments. Every week, we upload research videos on different companies, mutual funds, and financial topics. To stay up to date on the latest trends and insights, subscribe to our channel. So now let's back to today's topic, which is how you can protect yourself from any financial fraud. Did you know, according to RBI, in FY22, banks reported 9,102 frauds amounting to 60,389 crore rupees, compared to 7,358 frauds worth 1.37 lakh rupees crore in FY21. Even in the pre-pandemic FY20, banks reported 8,702 frauds totaling of 1.85 lakh rupees crore. Well, this is not something that can be solved individually, so what we can do is prevent. In order to understand financial frauds, then financial fraud can occur in various ways, and fraudsters don't follow a specific process. They are often intelligent and skilled at evading detection. Each fraudster has their own pattern, making it challenging for cyber teams to apprehend them. Well, here are some of most popular frauds. So before discussing the pointers directly, let's study about some historical financial frauds. Here, you can check the most popular financial frauds which happened in different years. Basically, these events impacted the general public and Indian economy very adversely. Like in 1992, Harshad Mehta scam shook the nation. In 2001, Ketan Parekh scam came into light. Even after almost 8 years in 2009, just after the global financial crisis, Satyam Computers disappointed the retailers, investors. Similarly, after some years in 2012 to 2017, ABG shipyard case came into existence. This has also impacted the retailers badly. So, here what we can understand that fraud is not ending here. Every year or a new scam or fraud shooks the nation with modern tactics and method. So it's important to aware about ongoing case in order to make wealth and protect for such fraudulent activities. The history teaches lesson to be cautious while joining any quick rich schemes. Now, let's discuss the pointers. First, unmasking difference between fraud and underperformance. Many dependent investors often rely on financial advisors or brokers to handle their investments. However, even professionals sometimes fall short in delivering satisfactory investment results. Various factors, such as market conditions or inefficiencies, can contribute to disappointments. So, how can one assess fraud and underperformance? To understand the difference, one has to consider some key factors like whether your financial advisor did the following or not. Did they discuss about your overall financial situation comprehensively? Did they assess your investment experience and knowledge of financial products? Did they determine several risk factors such as age, health, and financial obligations? Did they provide a clear understanding of the tax implications related to your investments? Has they planned a suitable investment portfolio based on the above factors? If your financial advisor has done all these activities prior recommending investment plan, then the underperformance has happened due to macro factors. So now, in order to identify fraud, you must have these key pointers in the mind. Solid proof of advisors which shows their negligence such as required skill sets. Proven shortcomings in services such as missed opportunities, investment in bogus schemes, exercising unauthorized trades. Now let's discuss the second pointer, mis-selling by banks and insurance companies. It has been seen that bank employees or insurance agents mis-sell the financial products to senior citizens. But have you ever thought why? Well, this is because bank employees have hard sales targets to achieve, which in turn forces them to push products that lead to high commissions. Generally, an agent who works for the banks or insurance agencies get paid very well. Since agents are paid commissions based on the number of sales they make, they may not keep their clients' interests in mind and will sell the policy which will earn them the maximum commission. Now moving to third pointer, detecting financial fraud. Key pointers to look out for. As we have discussed already, financial frauds usually exercised by most intelligent peoples. Carrying out such activities requires sharpest minds in order to execute such job. So how can we sense about this in early phase? A. Benefits which sounds too lucrative, wherein scammer or fraudster promising daily 3% to 5% returns on their investments. B. Promise of exclusive privileges and freebies. Offers free club memberships, higher value of cash coupon, tokens, free seminars, webinars. C. Unsolicited investment offers from strangers. Usually, fraudsters avoid F2F interactions, so they offer investments over phone calls and unofficial emails by leveraging technology. Furthermore, check below red flags: high guaranteed returns with unrealistic promises. Urgency and pressure to make a quick decision due to limited time offers. Claims that everyone else is participating or investing. Lack of specific information about the opportunity and absence of additional contact details. D. Lack of verifiable documentation. Another warning sign of potential fraud is the use of unverifiable documentation. Fraudsters may provide misleading account statements, promotional materials, or notices to deceive individuals and prevent them from verifying their investment performance. This tactic is often targeted at senior citizens who may not have extensive online account operation knowledge or are unable to visit a branch in person due to health concerns. So, if your parents have a financial advisor, it is important to regularly review their accounts to identify any red flags, such as unauthorized withdrawals, account closures with penalties, changes in investment portfolio risk tolerance, and unusual or unexplained banking transactions. Now coming to last parameter, that is of proactive measures to protect yourself fraud. If you are looking out the front picture and not the back picture along, then here you must have to be cautious. Check below key pointers. A. Trust them but not blindly. Generally, every frauds excel when people start trusting blindly. We have a long-standing, trusted financial advisor or salesperson who has been providing us with financial advice and selling financial products to our family for years. But have we ever checked legal documentation, licenses? So in order to protecting yourself, ask for these documents. Valid SEBI registration number as a registered investment advisor. Valid ARN registration number from Association of Mutual Funds in India. Registered with IRDAI as a corporate agent for selling insurance policies. And valid PFRDA registration as a point of presence for National Pension System. B. Chase potential returns instead of unrealistic returns. Avoid advisors who make promises of doubling your investments in 3 to 6 months. Such claims may appear tempting with high returns, but they often lead people to borrow money from friends and family, only to end up with blown accounts. So, be cautious, educate yourself, and seek clarification before making any investment to avoid falling victim to potential scams or impulsive decisions. C. Ensure privacy and confidentiality of financial products. Protect your finances by never sharing sensitive information like usernames, passwords, OTP, PAN, and Aadhaar. Mark self-attested copies of documents and avoid sharing blank papers or checks, even with trusted individuals. D. Work on your actions and biases. Reflection is the key for success, but many people implement exact to the opposite in their life. Often, investor biases such as urge for high risk, the need for infallibility, the pursuit of quick wealth, fear of missing out FOMO, and the tendency to reciprocate freebies fall them to becoming one financial fraud victim. A. Look for genuine professionals. Evaluating this parameter is crucial as it requires recognizing when your gut feeling raises concerns and having the wisdom to seek guidance from trusted experts who can provide objective insights based on their knowledge and experience. Moreover, what you can do is look for genuine reviews and do Google for extracting their history. That's it for today. For more discussion on stock research, mutual funds and investing ideas, visit our blog portal. Link is mentioned in description box. Like and comment if you find anything valuable.